Foreclosures are rising in Ontario, and if you live around the GTA, this isn't a forecast, it's already happening. Let's be clear, this isn't just another housing headline, this is a serious financial signal. More homeowners are defaulting, lenders are stepping in, and families are losing their homes, not by choice, but by force. Power of sale listings, the Canadian version of foreclosure, have more than doubled in the past year. In September of 2022, there was just 96 of these listings in the GTA. By September of 2025, that number jumped to 204. That's not a blip, that's not a seasonal fluctuation, that's a 112% increase. And every one of those numbers is someone's real story. A couple who couldn't renew, a single parent overwhelmed by rising bills, a property investor who over-leveraged in a hot market and got squeezed. This isn't just about people making bad decisions, it's about a financial system that changed faster than everyone could react. Think about it. In 2020, you could lock into a mortgage at 1.7%. Payments were manageable, the housing market was booming, confidence was high, and even the government told us that interest rates would stay low for a long time. Now, fast forward to now, renewals are coming in at 4.5%, sometimes higher. That's a jump of over $1,000 a month for many households. And that's if you qualify to renew. Some people don't. And even if you're not renewing yet, variable rate borrowers are feeling the pain already, especially those who took fixed payment variable mortgages. Many have hit what's called the trigger rate, where their payments no longer cover the interest of the loan. So what happens next? The bank steps in. They demand higher payments, or they restructure your loan. And if that doesn't work, they move to power of sale. That means your home is listed by the lender, not you. You don't control the sale. You don't negotiate the terms. You're just out. And while power of sale listings is still relatively small in the grand scheme, it's the rate of increasing that's the real story here. Because rising foreclosures are usually the last domino. Before that, people max out credit cards, delay bills, they take side gigs, they borrow from family, and then when there's nothing left, they fall behind on their mortgage. So if we're seeing financial numbers spike now, it means a lot of the financial pain has already happened behind the scenes. And if interest rates stay high through 2025 and 2026, we could be in for a rougher year than anyone expected. This video is going to break down what's happening, why it's accelerating, and what you need to know whether you own a home, rent, invest, or thinking of buying in Ontario. Let's start with the hard numbers because they'll tell the story all on their own. In September of 2022, the GTA had just 96 active power of sale listings. Fast forward to September of 2025, and that number has jumped to 204. That's a 112% increase in just 1 year. Now, on its own, 204 doesn't sound like a flood, but here's the thing. Foreclosures or power of sales in Ontario are a lagging indicator. They don't show up when people are first in trouble. They show up months after the financial stress, missed payments, legal action, and lender intervention. So when these listings begin to rise sharply, it means a wave of hardship has already hit behind the scenes, and more is likely coming. So what's exactly driving this surge? Let's break it down. Reason number one, mortgage renewals at dramatically higher interest rates. Millions of Ontario homeowners took out mortgages in 2020 and 2021 when rates were at a record low. Many were under 2%. I've even seen some locked in at a 5-year fixed at 1.5%. But now those mortgages are coming up for renewal, and the going rate is more like 4.5%. That's nearly triple. For a lot of families, that means that monthly payments could jump by $800, $1,000, or even $1,400 depending on the size of the mortgage. That's not a small adjustment, that's a lifestyle change. And if your income isn't on pace to keep up with inflation, or you're taking on other debts, it can be devastating. Which brings us to reason number two, trigger rates and negative amortizations. Let's say that you have a variable rate mortgage with a fixed payment. When rates rise, your payment amount stays the same, but the amount going towards interest increases and the amount going towards your principal shrinks. Eventually you hit what's called the trigger rate. That's the point where your payment isn't covering any interest anymore. When that happens, your lender may increase your payment, demand a lump sum payment, or require refinancing. And if you can't comply, that's where the trouble starts. Reason number 3, high consumer debt and shrinking savings. According to recent stats, household savings in Canada have dropped sharply since the pandemic. Credit card balances are at a record high, and lines of credit are being tapped into more now than ever. So when housing costs spike and other expenses stay high, there's just no buffer left. A lot of people are doing everything they can to hold on. They're maxing out credit cards, delaying bills, borrowing from family, even some are driving Uber at night, you name it. But it's not sustainable. And for homeowners who stretch to get into the market, who were right on the edge of their approval limits, those small changes can be fatal. Reason number 4, declining home values. During the boom, people assumed that their homes would keep appreciating. But over the past year, in many areas in Ontario, we've seen prices decline by 20 to 30%. If you bought during the peak and now need to sell, you may be underwater. That means your mortgage is worth more than what your home is. In those situations, listing the property doesn't solve the problem. You can't walk away with equity. You may not be able to walk away at all. And if you fall behind on payments, foreclosure becomes the lender's only option. So let's recap. Renewals are more expensive. Variable rate borrowers are under pressure. Debt levels are on the rise, and selling the home is no longer the guaranteed exit plan. All of those factors are converging, and they're starting to show up in power of sale listings. But it's not just homeowners who are vulnerable. Investors are getting hit too. A lot of real estate investors in Ontario bought during the frenzy of 2020 to 2022. They assumed rent would cover the mortgage, and if they didn't, appreciation could bail them out. But now rents are hitting a ceiling. Interest costs are higher, and vacancy rates are creeping up in some regions. Many of these investors are holding properties that are cash flow negative. Every month they're bleeding money, and at a certain point, it's just not worth holding anymore. Some will sell voluntarily, others, they will end up in the same boat, missing payments, forced sales, and foreclosures proceedings. Another warning sign, lenders are preparing, quietly but deliberately. Mortgage insurers are revising risk models. Banks are increasing reserves for bad loans, and private lenders who tend to serve riskier borrowers are starting to clamp down on renewals and demand higher collateral. This tells us that institutions expect distress to spread, not shrink. Now, just to be clear, we're not in a full-blown foreclosure crisis. This isn't 2008. Canada has a different lending system, but what we're seeing is just a significant shift in the momentum. Foreclosures don't spike overnight. They build slowly and then suddenly. And if interest rates stay elevated, if wages don't keep up, and if inflation continues eating away at disposable income, this trend will likely continue through 2026. It's not about panic, it's about a pattern of recognition. Because for most people, foreclosure doesn't come from one bad decision. It comes from a series of tough breaks. A little too much optimism, a few missed warning signs. That's why now is the time to look closely at the data and ask tough questions. Are we doing enough to help households avoid collapse? And most importantly, are we listening to the signals? Because power of sale listings are just the tip of the iceberg. The real story is happening behind closed doors, at kitchen tables, in lender meetings, in quiet moments of stress and confusion. So if you're seeing the early signs, missed payments, refinance rejections, anxiety around renewals, don't ignore it. This market isn't forgiving, and the sooner you act, the more options that you have. So now the question is, what do you do with this information? Whether you're a homeowner, a renter, an investor, or someone just trying to get into the market, the rise in foreclosures could be a signal, not a source of panic, but a reason to take action. Let's start with homeowners. If your mortgage is up for renewal in the next 12 months, don't wait for your lender to reach out. Get ahead of it. Talk to a mortgage broker. Explore your options, because the earlier you plan, the more leverage that you have. If you're on a variable rate mortgage, especially with a fixed payment, call your lender. Ask if you're near or past your trigger rate. Find out how much of your payment is actually going towards principal, or if it's just covering interest, or worse, adding to your debt. If you've missed a payment or feel like you might, call your lender before they call you. You might have more options than you think. Extending your amortization, switching products, or even temporarily deferring payments. But you can't wait until you're already in default. Be proactive. Now for buyers, yes, power of sale listings are rising, but in some cases, they can be buying opportunities. But don't assume these properties are guaranteed bargains. Foreclosure sales can come with complications, legal delays, property neglect, existing tenants. Always work with a knowledgeable agent and a lawyer. Don't skip the due diligence part. The right deal is the one that's sustainable, not just cheap. If you're an investor, this is the time for caution, not gambling. There certainly will be opportunities in 2025 and 2026, especially in distressed markets, but don't make the mistake of assuming the bottom is in. Prices could still move sideways or down in a short term. Focus on cash flow. Assume rates will be higher for longer. And above all, don't over leverage. And finally, if you're a renter or someone not directly in the housing market, you can still be affected, because when homeowners lose homes, when rental markets shrink, when instability spreads, it eventually shows up in rent, in availability, in policy decisions. The housing market isn't just the people who own real estate, it's the foundation of community stability. So whatever your position is, this is a moment for awareness, not avoidance. If you know someone struggling, please share this video with them. If you're facing financial pressure yourself, talk to someone, a lender, a broker, a financial advisor. Don't face it in silence. This is a tough time for Canadians, but we can get through it better when we talk about it, plan for it, and support each other through it. If this video helped you, hit like, drop a comment, and subscribe for more grounded, real-world breakdowns of what's happening in this market. I'm Justin Chaussee, and remember, your home is more than just a financial asset. Protect it with information, not fear. You've got options, and please use them.